Hey everyone, welcome back to the Vanilla Wealth. Today we'll be breaking down and oversimplifying some common investing terms that you ought to know before you start investing. Let's start with stocks. Stocks are share in the ownership of a company. So imagine you own a coffee shop and your cousin wants to invest in a piece of it. Each piece or share of the coffee shop represents a small part of the coffee shop based on its current value. So suppose you have 1,000 shares in total and the total value of your coffee shop business is $100,000. Each share is worth around $100. Your cousin wants some ownership of the coffee shop and is willing to put in $20,000. He can do so by buying 200 shares. Similarly, for publicly traded companies like Tesla, this means you can own a part of these companies by buying their shares. So suppose you want to invest $3,000 into Tesla. Since its current price, suppose is $300, you get yourself 10 shares of Tesla and boom, you are a part owner of Tesla now. Now let's talk about how we can make money from stocks. There are two primary avenues. The first one is dividends and the other one is capital gains. So what do these terms mean? Let's talk about dividends first. Dividends are a percentage of companies' earnings paid to shareholders. Suppose Lacey has invested in a dividend stock. In this case, let's say she invested $10,000 in Enbridge at the start of the year. Because it has an annual dividend yield of 6.22%, she can expect to earn $622 from dividends right into her account just by investing into the stock. Dividends are typically paid out quarterly, but there are other frequencies as well. Now, how about capital gains? This is the profit earned from sale of an investment. Suppose Lacey invested in 250 shares of Enbridge at $40 a share and sold it all when it reached $45. She would have capital gains of $1,250 in total. Now the other end of this, where you don't make a profit but you actually make a loss, is called capital losses. How does capital loss work? So let's take the same example, similar concept. If Lacey had invested in 250 shares of Enbridge at $40 a share and sold it all when it reached $35, she would have capital loss of $1,250 because her buying price is $40, but she sold it at a lower price for $35. The next term we'll be talking about is brokerage firms. It's just a fancy way of saying a company that connects sellers and buyers to complete a transaction. All of these companies you might or might not have seen are brokerage firms. Suppose Lacey wants to buy her first stock in a publicly traded company, but she doesn't know where to buy from. What she can do is she can open an account with a brokerage firm, and a brokerage firm will help investors buy and sell stocks. We can talk about which brokerage firms might be the right one for you based on your investment strategy at a later date. Bonds. So in basic terms, bonds are guaranteed payout by company or government in return for loaning them money. For example, if you were to invest in a 10-year Government of Canada bond, which pays out 4% fixed interest, you will earn $400 every year for 10 years. And at the end of the 10 years, you will also get back your $10,000, which means in total, you'll have $14,000 in your account. ETF. This is a very common term as well that people hear about but don't totally understand. ETF is Exchange Traded Fund. Think of ETF as a pre-packaged bundle of stocks. So imagine you want to invest in the top 500 companies in the US, but buying individual stocks for each company and deciding how much you want to invest in each would cost a lot of money and time, as well as expertise and research. Instead of buying 500 separate stocks, what you can do is buy a single share of an ETF such as the Vanguard S&P 500, and that one share gives you exposure to 500 of the leading publicly traded companies in the US. This way, you won't need to worry about how much you need to invest where. The ETF provider, in this case, would do the hard work for you. As you can see, the current holding of the Vanguard S&P 500 ETF consists of Apple, Microsoft, Nvidia, Amazon, so on and so forth. But the idea here is that you can also see the percentage of fund that's been allocated to each of these companies, which shows the amount of work that kind of goes behind. Now, diversification. This is like creating a safety net by spreading your money across different investments. By diversifying, you're less dependent on any one investment and reduce the risk of losing everything if one stock or sector performs poorly. Imagine both Lacey and Mark had $10,000 to invest in July 2020. Lacey invested in a company called Chegg. She invested $10,000 at $80 a share. Whereas Mark, he invested in Chegg, Tesla, Enbridge, and Apple. So he diversified his investment into 4 different areas, albeit equally. So fast forward to November of 2024. Let's see what happens to their $10,000. By November 2024, Lacey has almost lost all her investments as the price per share of Chegg changes from $80 a share to $2 a share, giving her a loss of $9,750. Whereas Mark, who diversified his investments across multiple stocks, and even though his value of Chegg shares fell down, he gained otherwise, making him an overall profit of almost $6,000. Well, thanks for watching again, and as always, if you're looking forward to more content, please give a thumbs up and hit that subscribe button. Until then, as always, keep it simple, keep it vanilla.